Go ahead and get started. Our first moderator today is Laura Tyson, Distinguished Professor of the Graduate School at the Haas School of Business at the University of California. Welcome, Professor Tyson.
No, thank you very much, Maurice. And good morning, good afternoon, good evening. Welcome. Delighted that we're all back together to discuss this fascinating topic of fintech and the future of payments. I want to start again by recognizing the funders. Some of you may have not been there yesterday with us, and I think it's very important to recognize that these kinds of events are only possible with funders. So Ripple is an important funder here, working through its Berkeley Haas Blockchain Initiative, which is a 5-year program to promote research and student engagement. Berkeley is one of 34 universities around the world that is partnering with Ripple in what's called the University Blockchain Research Initiative. I really want to emphasize that Ripple is really interested in promoting research in the area of blockchain, cryptocurrency, and fintech in general. The Kauffman Foundation is also a generous supporter, generous grant to a group of faculty headed by John Zeisman who look at technology and its applications to society and the economy. And then CITRIS, the Center for Information Technology Research in the Interest of Society, which is a 4-campus University of California research effort. I want to also note, since today we're talking about fintech for financial inclusion, that Berkeley is about to launch an entirely new initiative, indeed called Fintech and Financial Inclusion. It is again made possible with funding from Ripple. There will be a multidisciplinary group doing research and exploring applications for the use of fintech, modern technologies to serve the unbanked and vulnerable populations around the world. Paul Gertler, who is the presenter for this session, and Joshua Blumenstock, who is the commentator, have been leaders in working to get this initiative put together, and it will be launched this month. Paul Gertler is a professor of economics and also a professor at the School of Public Health. He's an internationally recognized expert on impact evaluation. He wrote the major textbook in this area. Professor Joshua Blumenstock is a professor at the University of California, Berkeley School of Information. He's a director of the Data Intensive Development Lab, and he focuses on using big data and novel data and methods to understand the causes and consequences of global poverty. So there couldn't be a better team to really talk about fintech and how you serve the vulnerable and unbanked around the world. I want to refresh for everyone the rules of the game for these sessions. The sessions are scheduled for an hour. Paul will have 20 minutes as a presenter. Joshua will have 10 minutes for his comments. The remaining 30 minutes will be available for discussion and questions. Of course, I'm responsible for moderating, and therefore I'm going to nudge, encourage, demand that Paul and Joshua stay within their time limits. And then I will be working with our ACE team, Maurice and Daphne, to handle the questions, to make sure. Raise your hand whenever you want. We'll keep track of who has raised their hand, and then we will turn to the questioners in the order in which hands are raised. Let me end there and turn over to Paul Gertler. Thank you, Paul. Thank you, Joshua. And thank you, everyone, for being here for this very important session.
Great, Laura. Laura is testing out the new presidential debate muting technology to make sure we stay on time. So we'll see how it works. Let me go ahead and share my screen. Okay. Laura, you want to give me a thumbs up if you can see it? Okay, 2 thumbs up. Very good. Good way to start. So as Laura mentioned, I'm going to talk about fintech and financial inclusion and how the new technology in the financial services sector has started to really revolutionize access to financial services amongst the banked and unbanked and underbanked. Where this starts out is We have 2 billion people in the world who have no contact with the financial system. They're mostly in low and middle income countries. There are probably another 2 billion who are underbanked, who have some contact with the system, but don't get access to safe saving vehicles, don't have easy transaction models, don't have access to credit. And there's a lot of work that's been out there that show that these 2 to 4 billion people would really benefit in terms of welfare from access to safe saving, formal savings vehicle, formal credit at reasonable interest rate, transaction technologies that not only lower the cost of transaction, but in the age of COVID, make transactions a lot safer, insurance products, and a big issue in a lot of these low and middle income countries are not only internal within national remittances, but international remittances. Countries like Mexico, the Philippines, Bangladesh, India, and several African countries, large significant percentages of their GDP come from overseas remittances. Now, just to frame this, savings, formal savings allows individuals to invest in productive enterprises and savings, create precautionary savings, credit and insurance for unexpected costs such as illness, job loss, weather shocks, lower monetary loss by keeping money in a bank from crime or social pressure to lend money, and impulse services. I can definitely tell you the amount of time I spent in Mexico stopping in a cantina because I had cash in my pocket as opposed to having to go to the bank to pull that money out. And substantially lower transaction costs really are key in a lot of these economies. There have been a number of important fintech trends in these low and middle income countries. One of the biggest and most market-changing activities has really been simple old technology of expanding debit and credit cards and POS machines to take those throughout the world. And a lot of this was jump-started by the 250 million individuals who are on cash transfer programs, such as pensions or welfare programs, UBI programs, or conditional cash transfer programs. A lot of those individuals were banked through those programs, depositing their monthly or bi-monthly transfers in a bank account and giving them access to debit and credit cards. That, I'm going to show you some work on that, lowered transaction costs to individuals dramatically, but it also allowed them a technology to monitor that institutions, the financial institutions, are not stealing their money and help build trust in those institutions. A big trend that really was popularized out of Kennedy, mobile money, able to make transactions on your phone. Both debit cards and credit cards and mobile money the effectiveness of those depend a lot on network externalities, that me having a debit card or a mobile money transaction account allows me to, it becomes more valuable the more vendors, the more stores that actually have POS machines to take it. And the value of a debit card or mobile money depends, or the value of a POS machine depends a lot on how many people have debit cards and mobile money. And one of the things we've seen in a lot of these economies is that it needs some big shock on either the demand side or the supply side individuals for this really to be scaled up and rolled out. We're starting to see now a movement of blockchain for transactions, and that's happening. It's a blockchain in these countries is really starting out in the international remittance markets. So blockchain dramatically lowers the cost of remittances. And I think we don't yet know how this is going to work. We're in contact with Ripple India, where they're now trying to create a big transactions market, and we'll see how that plays out. Another big area we see in these countries is digital credit. And so, in fact, our discussant, Josh Blumenstock, has made a lot of progress in this area. One of the big problems we have in these low and middle income countries is how do we establish credit worthiness? And Josh was one of the first to show that we can really take advantage of cell phone data, but in terms of where you're calling and how often you're calling to establish credit worthiness or poverty and wealth. And we've seen a lot of applications of machine learning or artificial intelligence to use cell phone data for credit scoring. And so what happens is if I have an Android phone, there are a number of countries who, if you give them access to your phone, they can download your cell phone use data and instantly determine your credit worthiness based on these ML models using cell phone data. And we're seeing that expanding. So there are also some efforts, which I'll talk a bit about today, to deal with collateral issues using this technology as well. And then a big trend in a lot of countries has to do with identity. And there's a movement to start to use identity technologies, thumbprints, essentially. So all of India has transformed its financial sector and its public programs essentially to using bioidentity technology. Okay, so I'm going to talk briefly about three developments. And of course, in an effort for shameless self-promotion, they're all based on my work. But note, this is a small drop in the bucket of research in this area. There's a very large body of work, especially in and around Berkeley. Some 20-25 faculty have, and grad students have active field projects in this area. Okay, so the three things I'm going to talk about is really the importance of trust in the technology and financial institutions, that really these populations have low trust over everything, and just giving them access isn't enough. We have to find ways for people to believe that these financial institutions won't steal money or won't skim off the top, and that if you put money in a bank, that money will be there when you want it. I'm going to talk a bit about some innovations in the credit market, leveraging something called lockout technology to function as collateral. So collateral in developed countries plays a role of providing incentives to repay, to deal with both the moral hazard and adverse selection functions to make sure people can repay. So it functions as incentives. It also functions as a store of value in case consumers default. So collateral has been quite important in Western credit markets, but it's relatively rare. In fact, it's extremely rare in low and middle income countries. And we'll talk about a technology facilitated by mobile money and by remote abilities to lock electric devices to play at least the incentive role of collateral in credit markets. And then finally, I'll talk a bit about AI or ML in credit scoring. This actually work with Josh, where what you can do is you can build in existing biases into these supposedly objective mechanisms for establishing credit. And in the case we're going to look at, this leads to biases against creditworthy women, and is maybe one of the reasons that female entrepreneurs are not getting access to credit at the same rate men are. So let me try and spend a few. Yeah.
Let me just say that you're a little bit more than halfway through your time.
Okay.
So we'd love to hear about the 3 developments. Just try to pick up a little bit.
Okay, well, I certainly could speak more quickly. No, I'll cut the material.
Paul has some great slides too, which I think we can share as well. So just go on.
Yeah, so I want to talk about trust in financial institutions. One of the big innovations in the last 10 years have been cash transfer programs depositing money in bank accounts. But in almost all these programs, beneficiaries immediately withdraw the cash and don't take advantage of the financial institutions. Why? We think one of the reasons was trust in the institution, that individuals believed that they couldn't get access to their money when they wanted it, or their money would be depleted due to unexpected fees and things like that. So we ran a field experiment in Peru with a conditional cash transfer program to increase trust. And we ran a simple training program to try and establish trustworthiness with a random set of beneficiaries. And you see a number of results. These are showing treatment effects on different measures of trust. And without going into them, this rainbow of colors suggests that trust went up quite a bit. And here are treatment effects in the amount of money left in the account for savings over time in 2-month periods. And so number 4, which is 8 months after the training, we see the treatment group had already started to save substantially more than the control group, whereas prior to the training intervention, 0 individuals in the control and treatment group saved about 0. Let me get my magic crayon up here. Okay. So that's just some evidence how important trust is in these institutions. A second intervention along this way looks at Mexico's conditional cash transfer program, Prospera Oportunidades, who in about 2010, before that, they'd been depositing beneficiaries' cash or transfers in bank accounts, but didn't have debit cards attached to them. And then in 2009, 2010, they started tying debit cards to those bank accounts. They rolled that out sequentially. They phased it in geographically over time, which gave us plausible identification of the effect of debit cards. And debit cards alleviate 2 barriers to using a financial institution. One is lower the transaction costs, but second, and importantly for this, is they reduce the cost of checking balances. And checking balances is a way to see if your money is still there. And so what we're going to show is they use these debit cards initially to check their balances very often and establish that they were there. Those people that had the cards longer reported trusting the institution more. And then eventually we saw savings rise. So here, this is 0, or right, the dotted line is when the debit cards were introduced. And this is share of clients using debit cards to withdraw ATM. As soon as they give you your debit card, you take your transfer via the ATM. Everybody does that. And then here what we see is there's only this number of withdrawals, treatment effects on number of withdrawals. Prior to the debit cards, everybody has 1 withdrawal. After you give debit cards, you're leaving money in there and you're having more withdrawals relative to the control group. And so we start to see that actual use of the accounts for transactions go up, and then savings rises after a period of time. This is when they're checking their balances a lot, and over time, savings starts to rise. And this shows that it's not a couple of a couple of people making lots of transactions and savings a lot. This is the share of individuals being able to save. And with debit card, over 80% of beneficiaries start to save. And so it's a deep and broad effect. And then here's the balance checking result. Early on, they're checking a lot more, and over time, as they build trust, that falls. This is just some evidence to show that trust goes up. Okay, so trust and market seems to be really important for adopting this technology, seems to be quite important for financial inclusion. I'd like to talk a bit about this issue of innovation and collateral. Collateral is used to prevent default on loans, both through moral hazard, incentives, adverse selection. It's not common in low and middle income countries, in large part because it's costly and because it's hard to enforce with weak institutions. So the courts side with the wealthy no matter what. So what the industry is doing is combining something called lockout technology with mobile money. So you give an individual a loan and they can pay back with mobile money on a daily basis. Then if you miss a payment and you have an electronic device, you can put a chip on that device that allows you to prevent the battery from working. And so you can lock that technology until they start to pay again. So what it does is the collateral now is the stream of services from the asset and not the asset itself. And that can really provide incentives and deal with the adverse selection. And it works especially in societies where there's a lot of uncertain income. Most people are self-employed or farmers. And so you expect fluctuations in income. And so how did that work? Well, we worked with a solar home system in Phoenix to run a field experiment on this. It also is in the market with smartphones and auto loans. And so what we did was we worked in Uganda to give households a school fee loan that they would pay back through this technology. Here's some pretty pictures of solar home systems. This is how the technology works. You get the loan, you get 7 free days of light, then you start making daily payments via mobile money, and then you get a code which allows you to unlock the technology for 1 more day, and you continue like that. These are pictures on repayment rates. So these are 100 days after you got the loan, 150 days after you got the loan, and 185. And these are loan completion rates. You expect loans to be completed earliest, say 110 days. The red line are the locked technology. The green line is the unlocked. We also had a surprise unlocked in an effort to identify moral hazard from adverse selection. But for this purposes, it's the difference between the red and green line, which show you the effects, the total effects on repayment. And then a lot of concerns over microfinance is people don't use the money for productive activities because of a fear of not being able to repay. Well, here that wasn't present. These were school fee loans. So we see a large effect on enrollment. So the control group has 87% of their kids in school, and about half of the unenrolled kids continue on to school who otherwise wouldn't have.
So Paul, you're largely out of time. So maybe one more slide and then I'll turn to Joshua. I like the slide on gender. So
well, I'll just say
whichever slide.
Yeah, I'll just say this and sum up, which is one of the big problems now as we see lots of countries and technologies turning to use machine learning to do credit scoring, like I talked about early on. What's happened is women are better repayers than men with the same financial history. And so what happens when women are pooled with men in a single credit scoring model, they tend to be rated as less creditworthy than they would have had they were treated simpler. So we think lots of creditworthy women are not getting access to credit because they're pooled with men. And here is a little exercise where we worked with a bank in the Dominican Republic. This is with Josh. We built credit scoring models that were pooled and separately for men and women. And then this plots the probability of repayment on the gendered models against the pooled models. And if they predict the same thing, all the data would be on the 45-degree line. But what you find is about 3/4 of the women are above the line, suggesting they do better under a gendered model than a pooled model, and that there are a large number of women who are not getting access to credit who otherwise would. So let me end here. Fintech has the potential to help 2 billion. I think I overestimated the number of underbanked by a couple trillion, but it's 2 billion unbanked and another 2 billion underbanked. To really help them reap benefits from savings, credit, transaction, and insurance. Barriers are trust, the expansion of technology with network externality issues, and exploitive business practices. In an area which is really lagging in these markets is really consumer protection laws and regulation to deal with some of the exploitive practices associated with this technology. So thanks, everybody. I'll turn it back to the...
Now we're just going to move on to Joshua. Joshua, for your comments.
Great, thank you.
All right, I'm trying to get out of this.
Oh, okay.
Let's see. Do you have control, Josh?
I don't. I think you have to stop sharing. Oh,
there we go.
Swapped.
There we go.
Let's see. Can you all hear me and see my slides?
Yes.
Great.
Yes,
so thanks very much, Barry and John, for this, and Laura for moderating, and also Paul for the remarks. I will spend just a few minutes doing what I was told a good discussant does, which is to sort of reprise and riff. So I'll highlight what I think are the key points that Paul brought up, as well as add a little bit of texture to a couple of the sub-bullets that I think are particularly interesting. So the first is Paul highlighted the fact that the proliferation of digital technologies, and really we're talking about low-end feature phones right now in low and middle income countries, has created a massive opportunity to expand the formal financial services to previously unbanked. So I think Paul had a slight overestimate. I guess he was rounding up a little bit, but 1.7 billion adults globally lack access to a bank account. And what's really remarkable here is that 2/3 of that 1.7 billion people without bank accounts have a mobile phone. And so you can see in the bottom, let me just change my cursor, corner here, just the growth of mobile money accounts in sub-Saharan Africa has been really exponential. And one other point I want to make, which is sort of implicit in a lot of what Paul talked about, is when you have billions of people all of a sudden using mobile phones and mobile money accounts, this is a lot of people who were previously, to use the phrase of James Scott, like illegible to the bureaucracy and to private firms, all of a sudden are generating vast quantities of data that can be used both by private firms for product design, credit scoring, insurance provision, and so forth, as well as by local and national governments. And so some of what I'll highlight is some of the innovations that take advantage of this new source of digital data. But one thing that's important to point out is that with very few exceptions, you see mobile money being adopted everywhere, but sustained use of mobile money beyond just basic remittances and peer-to-peer transfers is very rare. So there are a couple of very salient examples, in particular in Eastern Africa, where you see, like in Kenya, the use of mobile money is ubiquitous and people are accumulating savings on their accounts. But in most countries, what you see is what I'm showing you here. This is a project that's ongoing right now in Togo, is that people use the account, but only very superficially. So the government of Togo, in response to the coronavirus pandemic, started sending out a bunch of G2P cash transfers that were paid out via mobile money. So in April, about 500,000 citizens of Togo, this is about 10% of the population, received a cash transfer from the government that was, and all of those transfers were delivered via the mobile money platform. And we look at the transactions data and we see that about 200,000 of those 500,000 individuals created a mobile money account for the first time because of this program. And what you see on the right is looking at the transactions data, that the vast majority of them cash out their full transfer almost immediately. In other words, and this speaks to some of the issues that Paul raised regarding trust, but when greeted with for the first time with this new financial ecosystem, people basically want to exit as quickly as possible and have cash in their hands. So I think there's a lot of more social barriers to widespread adoption of this ecosystem. The second point that Paul brought up is the really incredible opportunities, not just for superficial financial inclusion, but the potential for financial inclusion to have knock-on effects on broader dimensions of welfare, on consumption smoothing and so forth. Paul highlighted several. This slide brings up several others. I thought I'd briefly just talk about two. I already mentioned the idea of social safety nets, but this is something that I think is really interesting right now. So I just looked up the statistics. Since March of this year, there have been 200 new social safety nets rolled out in low and middle income countries. And this is largely in response to coronavirus. So as governments have been implementing lockdown orders to prevent the transmission of the disease, this has also stifled, especially urban economies. And so a lot of governments have seen large portions of the population that were previously living at subsistence levels slip below subsistence. And so these social safety nets are designed to provide rapid response to the really massive humanitarian crisis. And about 60% of these programs are cash-based. In other words, the government just wants to get money out the door as quickly as possible to these very low-income individuals. And in a large number of cases, they're relying on mobile money. And so I think something here that's very interesting is that this is a really sudden shock to both the digital identification system and to the electronic payment system. And so it'll be interesting to see how this plays out over time. Because a lot of these governments didn't previously have a centralized universal ID system. But that is something that they need to sort of solve overnight if they want to be able to track and disperse payments to large portions of the population. So this is exactly what we're working on in Togo. Paul also mentioned this ecosystem of digital credit that has sprung up. And again, just to provide a little bit more context, in Kenya, recent survey evidence suggests that over a quarter of adults currently have an outstanding loan on one of these digital credit systems. And this is sort of like a mind-boggling statistic to me. And what that means is these are people who it's not necessarily through a bank, but their access to the loan is mediated by the mobile phone. And as Paul said, a key insight here is that information on how people use their phone, like literally the number of phone calls and text messages they make and the people that they're communicating with, forms the basis for a credit score that is used to make a loan determination for an individual that has no other formal transaction history that would form like the basis for a FICO score or something like that. So again, over a quarter of Kenyans have a loan where the loan decision was based on phone use, not on traditional financial records. But the other sort of counterpoint here is that while there's massive potential for these new products to have positive welfare impacts, there's very little evidence that the existing set of products are having anything near the transformative effects. And quite the contrary, you see really an active debate in the policy arena about the potential negative effects of the rapid expansion of credit and other products. And so there's, this is something we're just seeing the first studies come out of this. There's an initiative at Berkeley called the Digital Credit Observatory, and now this new initiative that Paul and Laura mentioned, that Ripple has helped set up around fintech and financial inclusion, that are really designed to provide some of the first cohesive body of rigorous evidence of if and how these products can help consumers and how to improve product design in a way that's improves consumer protections.
So Josh, can I ask you I think you have one more point and we really should move on to the question. So just summarize point 3.
This will be my last slide.
Perfect.
Maybe I won't go into the details. I think Paul mentioned this briefly in the context of the re-engineering the digital credit algorithms to make sure that women aren't disadvantaged. There's a lot of really interesting work in this space that sort of is at the frontier of both applied economics as well as computer science, and thinking about how to innovate the core machine learning algorithms that are used to make things like credit scoring decisions. So in this example, what we're doing, I won't talk you through it, is we're actually predicting using the same machine learning algorithms whether a loan applicant is likely to derive some sort of positive welfare benefit from receipt of the loan, and integrating that into the credit scoring methodology. So I'll skip this and just leave this up here as I wrap up. And again, these I think are the 3 points that both Paul and I are emphasizing about the promise of fintech and financial inclusion in low and middle income countries. With that, I'll wrap up. Thank you, Laura, for keeping me on.
Thank you. Thank you very much, Joshua.